Okay, so economics-based financial planning and your lifetime balance sheet. Your lifetime balance sheet is really kind of the central component of economics-based planning and the central component of your financial plans. We're going to talk a lot about that today. Quick outline. Before I can talk about the economics-based approach, I have to talk about the conventional approach to financial planning. Then I'm going to talk about economics, lifetime balance sheet, and again, shoot any questions that you have at me at any time. Okay, so conventional financial planning. Conventional financial planning, if you're working with an advisor or a planner and they're doing any type of financial planning, those recommendations that they provide to you, like about things like saving, how much you can afford to spend, how much life insurance you need, how much risk you can afford to take with your investments, those recommendations are coming from some sort of framework or financial planning software that is being used. The conventional approach to generate those recommendations uses rules of thumb. And the primary rule of thumb that is used is a guess, a best estimate or a guess of how much you plan or hope to spend in retirement. This guess, first off, it's a guess, which means that it could lead to, you could guess wrong, you're likely to guess wrong, which can have impacts on the recommendations that are provided. And it's going to have potentially drastic effects on the recommendations and the outcomes that you might see in your financial plan. So all of the recommendations, again, all the recommendations that come out of this approach start with a guess of how much you're going to spend in retirement. Now that guess is based on what's called, often referred to as an income replacement ratio, a fancy word that says, we're gonna look at what your pre-retirement income is. We're gonna take 70 to 80%, and we're gonna say, that's what you can expect to spend on your living standard in retirement. Okay, so, but it's a guess. It's guess based on historical national averages. And I like to say that averages don't apply to you, they don't apply to me, and they certainly get in the way of a personalized financial plan and the recommendations. So what happens when you guess? Well, it leads to inaccurate recommendations around saving and spending, life insurance, and investments. So I'm an economist, right? So I have to show you figures, or else I wouldn't be considered a card-carrying economist. So hang in there with me. I'm going to show you some charts. So here on the x-axis, we're just looking at age. I've broken this down into pre-retirement and in retirement. So when you're earning, you're working, and when you're not. The y-axis here is your living standard. I'm going to talk a lot about your living standard. Economics-based planning really revolves around your living standard. That's just another word for how much you spend on discretionary spending, on your lifestyle. So conventional financial planning, it starts with a guess. It starts with a guesstimate of how much you're going to spend on your living standard out in retirement. Now, let's talk about saving and spending, okay? If you guess what that spending is going to look like out in retirement, it could lead to recommendations that are inaccurate around how much you need to save and therefore how much you can afford to spend now. So let's just imagine this is, say, a 40-year-old, hypothetical 40-year-old. If you guess too low of what your spending is going to be like in retirement, the recommendations for how much you can spend and therefore need to save now are going to be too high. So it's going to say, spend more now, you don't need to save as much, because when you get to retirement, you're going to have a lower living standard. This is one of kind of the worst outcomes, right? Because what this can lead to is a disastrous, potentially disastrous reduction or disruption in your living standard when you get to retirement. I've never met anyone, let alone a client, who is comfortable with dramatically reducing their living standard in retirement or really at any point in their lifetime. So this is kind of a really bad scenario, is that if we guess spending is too low in retirement, we're going to say you don't need to save as much now, which is going to lead to a very harsh reality when you get to retirement. The opposite is also not ideal either. If we guess too high out in retirement, then the recommendations for how much you can spend and therefore need to save are going to be inaccurate now. It's going to tell you that you need to save a lot more now, and that you're going to underspend, that you need to spend, you can spend less. Well, most people would prefer to save more than to save less. I don't disagree with that. Most people are risk averse, but this is also not an ideal outcome either. Why? Because when you get to retirement, you're going to say, well, that's great. I've got ample resources to pay for my living standard and all my expenses, but you might have some regret about how you didn't spend more when you could in the earlier years. And that's real. I've actually had conversations with clients that say, you need to go out and spend more. Or they come in and we're doing a retirement plan and it turns out that they have more than enough resources. And I think there's a sense of regret. Well, I could have spent more. This is also not ideal. Let's talk about life insurance. If you guess in retirement that your living standard is going to be, say, up here, a little bit too high, right? Again, the recommendation from conventional financial planning is that you need to save more now and spend less. Well, the recommendation for life insurance is then that you don't need as much life insurance because you're saving a lot more now. If I'm saving a lot more now, all else equal, I don't need as much life insurance to protect my surviving spouse and dependents. So this is that really terrible situation where you're underinsuring. And God forbid, something happened to me. If I don't have enough life insurance to support my partner and my kids, that's a disastrous outcome, having too little life insurance. The opposite is also not ideal, potentially not as disastrous. I think like saving, we'd rather save more than less. We'd rather have more life insurance than too little. But still, I don't know about you, but I'm not a huge fan of buying things I don't need, especially when it's insurance. Very few people like spending money on insurance. I'd like to have the right amount of insurance. So if we guess that the living standard in retirement is too low, it's going to say we don't need to save as much now. We can spend more. All else equal, that means we need more life insurance. So the recommendation from the conventional approach is buy more life insurance. And again, I'd rather have more than less, but I'd also rather have more money in my pocket so I can spend it on things that I enjoy rather than life insurance. And last but not least is the investment recommendations. Okay, and this is a really, really important one. If the guess is too low in retirement, the recommendation around how much stock you can afford to hold in your investments. So let me take a step back here. Stock is holdings of individual securities or mutual funds or ETFs, right? Stock is inherently risky. No one knows what's going to happen to the market. As we've seen over the last month, things have dropped precipitously, very fast. Stock is risky. And in our financial plan, a big component of the advice that we get from our planner, from our advisors, how much stock should I hold in my investments versus, say, less risky investments like bonds or fixed income. So holding too little or too much in particular stock is not ideal, right? We want to hold the right amount of stock because it's risky that we can actually afford. So if we guess too low of our spending in retirement, the recommendation on how much stock we can afford to hold in our investments is going to be too conservative. It's going to say, don't hold a lot of stock or hold less. So in essence, we're holding too little stock. What that means is that we might be missing out on kind of expected returns that we could get in the stock market. Nothing in the stock market is guaranteed, but stocks return an expected higher return than things like bonds. So investing less of our assets in stocks, all else equal, over a long period of time, we're likely to miss out on some returns. So that's not ideal. The other side is really the bad one. This is the bad outcome. If we guess too high on what our spending in retirement is going to be, the recommendation for how much stock you can afford to hold is going to be too much. It's going to be an overly aggressive recommendation. And I don't think I need to tell anyone that holding too much stock can really put your financial future at risk. I hope none of you are in this situation or none of your clients are in this situation, but I know folks are out there right now who may have been holding a way too aggressive portfolio, whether they knew it or not, too much stock. And right now they're at or starting retirement and they just lost 30% of their investments. That's scary, especially if you can't afford that amount of loss in your portfolio. So this is a really important, not to have too much stock in your portfolio. Okay, so as this scary individual here suggests, the whole point of this is stop guessing, stop the guesswork. There's a better way. We don't need to guess how much our spending is going to be in retirement. In fact, we can actually solve for it. There's a better approach. The economics-based approach, okay? So economics, as applied to financial planning, rather than guessing how much we're gonna spend in retirement, can actually be used to solve for how much you can afford to spend in retirement, and actually how much you can afford to spend throughout your life. So take the guesswork out of financial planning and actually solve for how much you can afford to spend and therefore need to save. So how does this approach actually work? How does it actually solve for spending and saving? It relies on two things. So one is fact and one is common sense. The fact is that over our entire lifetime, we can't spend more than we have in financial resources. Basic fact, okay? So in any given year, I could go take out a second loan on my home. I could potentially get a personal loan. I could basically spend more than I earn, right? I could go into debt in any given year. Over our entire life, we can't do that. We can only spend what we have available. So in terms of kind of a basic equation here, this just says that our lifetime liabilities must equal our lifetime assets. Liabilities is spending, assets are resources. So we can't spend over the rest of our life, that's our lifetime liabilities, how much we expect to spend from now through the end of retirement, must be equal to our lifetime assets. And our lifetime assets are all of the assets, both current savings and future income, that we have available to us to spend over the rest of our life. What this equation is telling us is that we have a lifetime budget. That's your lifetime balance sheet. Okay, we're going to talk about that. So fact, we've talked about fact. Common sense. The common sense component is that people prefer to maintain a smooth standard of living throughout their lives. And that is, this is what economists refer to as consumption smoothing. This is that simple idea that no one wants to live in poverty now so that they can live like a king or queen in retirement, or vice versa. People really prefer to keep a stable, steady amount of spending, have a steady living standard, not only through retirement, but actually throughout their life cycle. So these two components together are what generate all of the recommendations and actually solve for how much you can afford to spend. So I want to let's dive into the fact first. So again, this is your lifetime balance sheet. So of course, another fun figure. This is just a waterfall chart. Like any balance sheet, you have assets and liabilities, okay? Your lifetime assets include current savings, how much you've saved in your bank accounts, your non-retirement accounts, and your retirement accounts, all the savings that you've done till today, plus all of the future income that you can expect from now through the rest of your life, through the rest of retirement. So this is, say this is a hypothetical 40-year-old. Okay, they've done a good deal of savings thus far, but the biggest asset on their lifetime balance sheet is not their savings. It's actually what economists refer to as their human capital. That's what you project to earn over the rest of your life and also get in Social Security, okay? So a 40-year-old, the younger you are, the more you have of human capital relative to financial capital. Financial capital is just your savings. As you age, as we move through our life cycle, what we're doing is we're earning money, we're spending some, we're saving the rest. And so what we're doing is we're converting our earnings, our human capital, to financial capital. And I bring this up as just something to think about, in that how much human capital versus financial capital you have at any point in your life is going to have a big impact on recommendations around insurance and investments, for example. Okay, so these are your lifetime assets. So this hypothetical individual has $10 million of, say, lifetime assets. The lifetime balance sheet tells us they can't spend more than $10 million from now through the rest of their life, say age 100. So let's talk about the other side of the balance sheet, liabilities. Your lifetime liabilities I break up into two categories. The first is what I call committed expenses. So over the rest of your life, you're committed to a handful of expenses, okay? Unfortunately, we all have to pay our taxes. So I'm committed to paying my taxes, excuse me, from now through the rest of my life. I'm also committed to carrying certain types of insurance, health insurance, life insurance, etc. I'm committed to maintaining my housing situation or making certain adjustments to housing. So for example, I'm committed to paying my rent or my mortgage, property taxes, utilities maintenance, etc. And then lastly are what I call goals. This is one of the fun parts of financial planning, is that everyone's different when it comes to our goals, our values, our objectives in life. So from a financial perspective, one major component of committed expenses are our goals. So things like, I want to do a major home remodel. I want to do some extra travel in retirement, gifting. I've got to purchase a car every 7 or 10 years. Childcare, college is a big one, right? A wedding, any kind of large, atypical expense that is goal related is going to be committed. So in terms of our financial plan, I'm kind of committed to those goals. Thanks, Todd. Great. So those are committed expenses, right? I'm going to kind of, for lack of other words, I'm going to really bake those into the financial plan. Those are fixed off the top expenses. Now, let's return to this idea of our lifetime balance sheet. That simple equation that we can't spend more over our life than we have in resources. So now we're going to do some really fancy algebra. It's called subtraction. We're going to take our lifetime assets and we're going to subtract what we're committed to spending, so our committed future expenses. And what do we get? What's left over is what is available to spend on our living standard, on future discretionary spending. So what are we talking about here? We're talking about food, entertainment, leisure, personal care, technology, transportation. These are kind of budget-like items, things that are stable month to month, year to year, are discretionary spending. So what have we just done? Economics-based planning, at the end of the day, what it's solving for is this yellow box, okay? It's solving for how much we have available over the rest of our lives to spend on our living standard, to spend on discretionary spending. How does it do that? It takes into account what our lifetime assets are, so we have to look over the rest of our life, what do we expect to earn? What kind of income do we expect to have? And what are we committed to spending our money on? Taxes, insurance, housing, and other financial goals. What's left over is available for discretionary spending. That's the lifetime balance sheet in a nutshell. Now, we've just identified how much we have to spend over the rest of our lives. The follow-up question is, how are we going to spend it kind of over time, right? And that's where this common sense piece about maintaining a smooth standard of living comes in. So the approach, the economics-based approach in this hypothetical example takes the $3 million that's available for discretionary spending and it smooths it out, or it spreads it out in a way over say the next 60 years for this individual in a way that maintains a steady living standard. So I just want to contrast this with the conventional approach. So the conventional approach we talked about early, we're guessing what this number looks like out in retirement. And if we guess wrong, say for example, we guess too low, then we're going to have this disruption in our living standard in retirement. We're going to spend more now and spend less later. Economics-based planning is saying, stop guessing, take the disruption out of our financial lives and actually solve for the smooth amount of spending, the highest affordable living standard. So just to kind of tie a bow on this, in the most simple way possible, in this kind of hypothetical example, this person has $3 million. The program, the approach, all it's doing is it's kind of dividing it by the number of years remaining in this individual's life. So for this example, $3 million divided by 60 years, kind of in this simplified world, this person can spend $50,000 a year every single year for the rest of their life, and still meet all of their other financial goals. They can still afford to do the spending that they want on housing. They can obviously still afford to cover their taxes and insurance premiums, and they can still afford to, say, for example, go on some expensive travel, do additional gifting in retirement, maybe send kids to college, whatever it might be. After all of those are taken into account, every single year this individual can spend $50,000 a year on their living standard. So I just want to take a step back and say, hey, what we just did here is really powerful stuff. Rather than guessing how much we're going to spend, we've actually solved for how much we can afford to spend, and how much we can afford to spend every single year, year after year, and not run out of money. So this is something that's really powerful. So the next step here, I think, is really the fun part. This is one of the big value adds of this approach, is that if everything is focused on this living standard, how much can you afford to spend every single year on your living standard? We can do a lot of financial planning, a lot of planning around that solution. So one is we can compare it to what we're currently doing, okay, and what we kind of project that we're doing going forward. So for example, let's just say this person is spending, say, $44,000 a year on their living standard. Okay, well, the first thing that we realize is that they're spending within their means, right? The plan says that they can afford to spend $50,000. They're spending less. So if this person came into my office and we did this plan, we get to have the awesome conversation that says, you need to go out and spend $6,000 to $7,000 a year more. Let's talk about how you're going to do that. Because you're spending within your means. You can afford to spend more. Now the value of this approach really comes to fruition when we talk about doing kind of what if analysis. So for example, let's imagine, I'm just going to go back here. Let's imagine that this initial scenario here that we ran was kind of the status quo base scenario. This person continues to work in their current job. They plan to work through age 65. They're going to continue to rent their apartment. All of those things, okay? Now, what if they would really prefer to retire early? Maybe they want to retire at 62, 63. We could do a what if scenario. We could say, well, what would happen to your financial plan, and therefore how much you could afford to spend if you retired earlier? Well, if you go back to the lifetime balance sheet, you realize if you retire earlier, you're going to have fewer earnings. You're going to have a smaller amount of lifetime assets, which means all else equal, you're going to have less to spend on your living standard. So for example, this person, we rerun the plan. We do a what if scenario that you retire early. It's going to come back, it's going to say, well, you can only afford to spend, assuming that you do retire early, you're going to have to cut back on your spending. You're actually not going to be able to afford the $46,000 a year. You're going to have to cut back, or 44, or whatever this is. You're going to have to cut back, or you're going to have to make some other adjustments in your plan. Again, this is what's so great about this approach. We can do some financial planning and say, well, I really do want to retire at 62 for whatever reason. You know, that's a goal of mine. So what else can I do? Maybe I've got a side job. I can do a little bit more consulting. Maybe I can cut back on a few expenses that I just know, aren't really that important to me. So whatever that might be, say I have a side hustle, I'm going to earn a little bit more money over the next couple years, or several years, and we rerun the plan and we find, okay, now it works. This person can spend, now I can spend $45,000 a year, which is slightly above what I'm currently spending, and kind of voila, we've now figured out a way for this person to meet all of their objectives and still maintain their current living standard. And I just want to say that this applies, this can answer really any question, any financial planning question under the sun. The focus is your living standard. So for example, say it wasn't retirement, say it was, how much house can I afford to buy? Most often, if you speak with a financial advisor or financial planner, when they think about affordability, they're gonna think, well, can I afford the payments? Okay. From this approach, it has really very little to do with kind of the payments or the cash flow. It has to do, can I afford that house and still maintain my living standard and all of my other financial objectives or financial goals? That's what it means to be affordable in this perspective. So let's say over here, this gentleman, he was renting, and he says, well, I'd love to buy this $1 million house. Okay, we run the plan, and it turns out, well, you could do it, but you'd have to cut back, right? You'd have to cut back significantly. You'd have to cut back $10,000 a year on discretionary spending or make some other adjustments. And that person might say, well, no, I don't want to do that. How much house can I afford? We rerun the plan, say it's a $500,000 house, and it works. Or I might meet with someone else, and they say, no, I really want that $1 million house, and I'm willing to make other sacrifices, okay? So that's where I just want to highlight, that's where the financial planning comes in. And you can run this, you can do what if scenarios on anything. Things like, should I downsize my home later in retirement? Can I afford to downsize my career? Meaning, can I take a lower paying job now? Can I afford to move to a higher cost of living city? Can I, should I do Roth conversions? Should I make contributions either to my traditional IRA or my Roth IRA? This approach can be used to answer any financial planning question you can imagine. Okay. So I know I'm early. I've got some additional slides on cash flow, which I'm happy to jump into. Are there any burning questions at this point? Otherwise, I'll jump into the cash flow, which I know will also be valuable. But I wanted to give ample time for questions if they come up. Okay, everyone's got it. No pressure, it's okay. Okay, thank you, Laura, thank you, Vera. This is great. Okay, so let's talk about cash flow. And again, a good teacher, no questions. I wish. So let's talk about cash flow. This is, and I don't mean to scare anybody with all these numbers here, do the very best that I can to explain this. Cash flow is just another word for money comes in and money goes out every year. Okay, so the inflows into our life, say on an annual basis, are our income. Things like earnings and investment income. If we're retired, it would be retirement income, so like draws from our IRA. Spending, these are the outflows. Things like our discretionary spending, that's our living standard, taxes, insurance, housing, and goals. The difference between what comes in, the income, and what goes out, spending, is how much we're saving every year, the net cash flow, okay? So cash flow, no matter what financial planning software you're using or financial advisor you're meeting with, you will always talk about cash flow. Cash flow is really important for planning. But I want to highlight here how it looks a little bit different in the economics-based approach as opposed to the conventional approach. So first I want to remind you that what is economics? What is this approach doing? It's solving for how much we can afford, how much you can afford each and every year on your living standard, okay? So it's solving for a smooth $50,000 for this individual, right? Every year they can afford to spend $50,000. So how much that person has to save year in and year out simply comes right out of the cash flow. I'll explain to you what I mean by that. So let's look at the first year. So they've got some earnings, some investment income, and they're doing all this spending, including $5,000 on their kind of goals that they're spending. So the difference between what comes in and what goes out is $48,000. In terms of the plan, this approach is saying this individual needs to save $48,000 in this year in order to support that amount of spending throughout the rest of their life. okay? But what's different about the economics approach as opposed to, say, the conventional approach is that the economics approach, the amount of savings every year is going to vary. It's going to vary to the extent that any income or spending is variable. Variable, I just mean, is changing, right? So let's say in the next year, this individual earns the same amount, they're spending the same amount, but they're going to spend $60,000 on home improvements or a remodel of their kitchen, okay? Well, that means, according to this plan, they're not going to still spend $60,000 and save $48,000 that year. No, no, no. They're actually going to spend. They're going to actually take $12,000 out of their accounts to afford that spending. And according to the plan, that still works. So this is in contrast to a lot of the rules of thumb that are used in conventional planning, which say, save, say, 20% of your income every year. That's not very helpful if there is changes to your income or to your spending. Because in any given year, you might actually not need to save anything, or you might need to save a lot less. And in some years, for example, look at this person in 2020, they got a raise or a bonus. In that year, the plan says you need to save a lot more of that money. But in the year where you're doing the home remodel, you don't need to save as much. So I highlight this point that it's in contrast to conventional planning, which often recommends save a certain amount of your income. That's just guess. That's just the guesswork. We don't really know if that's the right approach. The right approach is to focus on your discretionary spending, because if you don't spend it, you're going to save it. So really focusing on how much you're spending every year on your lifestyle, on your living standard, saving is just going to happen. Now, I don't want to be naive. Where you save the money also matters, right? What accounts do you save it in? But that's a secondary question. Making sure that you're spending no more than you can afford and therefore saving the right amount, that's the important component here of this approach. So that's what I have for cash flow. And then let me just wrap up with conclusions. If anyone has questions, go ahead and send them my way. So to wrap up, I would just say that economics-based planning answers some big important questions that conventional planning simply can't answer. The first is how much spending is affordable. So again, rather than guessing how much you're going to spend in retirement and therefore generating recommendations about how much spending you can do now, economics-based planning takes the guesswork out of it and says, we're actually going to solve for how much you can afford to spend. And that's incredibly valuable because we can then do planning around this idea of how much can we afford to spend? Well, if we need to make adjustments to our plan, we know that we can go back and change certain things. Or we have an answer to, is this affordable? Can we afford to retire at 60? Can we afford to retire at 65? Can I afford to buy that vacation home? Da, 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 da. It really allows us to answer that question of affordability. The flip side of spending is saving. So it tells us how much saving is required in order to maintain that stable level of discretionary spending. Number 3 and 4, we didn't have time to go into the nitty-gritty of this, but we talked about it at the beginning. And that is that the economics-based approach, by actually solving for how much you can afford to spend each and every year, it's also going to accurately estimate and recommend an amount of life insurance that will result in maintaining the living standard, the lifestyle of any surviving spouse or dependents. Okay, so it gets the life insurance recommendation correct rather than having it come out of a guess of what you're spending. And last but not least, a very important component is the investment recommendations. So again, economics-based planning, by guessing or by solving for how much you can afford to spend, it's going to recommend, it's going to accurately quantify how much risk, i.e. stock, you can afford to hold in your investments. You don't want to hold too much because then you risk losing too much where you have to make sacrifices in your spending in retirement. And it doesn't tell you to hold too little. It's going to actually help you identify how much risk you can truly afford to take with your investments. And then I think really one of the biggest, most important things about this approach is that it provides really meaningful what-if analysis or scenario analysis, where because we're focusing on solving for the highest affordable living standard, we can rerun all types of different what-if scenarios. What if I downsize my home in retirement? What if I don't? What if I delay Social Security? When's the best time to file for Social Security? Any question you can possibly imagine, we can run a what-if scenario and we can say, is it affordable? Can you continue to maintain your living standard and meet all of those other future goals and objectives that you have? So just to reiterate, it's a life cycle approach. We're planning over your entire life. So it's going to capture future plans around your job and your career, housing, what your plans around housing are, your children, things you want to do, you might want to do in retirement, gifting, etc. So it's really a life cycle approach to financial planning, unlike a lot of conventional planning, which is less so. So that's what I've got. Let's see, where did I put my thank you slide? Here's my thank you slide.